Hello everybody. So this video is entitled MSTR Stock Strategy Buys More Bitcoin, and I expect a very small buy this weekend, perhaps 32 Bitcoins. I also want to talk about some weekend debates, weekend stats, talk about the MAG 8, talk a little bit about what we need for Stretch to get back to 100. Let's get started. So, of course, adding more dots. So like I said, I expect a small dots. Trending today is this debate about common equity Bitcoin exposure versus Bitcoin per share. Common equity Bitcoin exposure is the very conservative metric. It's the one where you take out all of the debt. Bitcoin per share is a quote-unquote dumber metric because you just look at the accretion of Bitcoin without removing the debt. And Saylor is arguing, obviously, that if the debt was short-term, CEBE is what would matter the most. And if the debt is long-term, long duration, then it's Bitcoin per share that matters the most. Bitcoin per share matters most to long-term shareholders. CEBE matters more to short-term traders and short-term holders who are claiming that we are going out of business. That's what matters much more to them, and of course they want to emphasize that, but BPS is what matters more to us. Why? This is a battle I've fought on this channel for a long time. But anyways, BTC per share matters. Why? Because we have perpetual preferreds. The convertibles may need to be paid back with cash if we are very bearish in 2028. If in 2028 Bitcoin is still sitting at 60K, the odds are we will have to pay some of these prefs with cash. But they could also be refinanced. So it's not that big of a problem. If you think Bitcoin is going to be higher than this in 2028, higher than 60K, if you think that, then the converts really are not a problem for you. And then, of course, the discussion needs to move towards the perpetual preferreds. And the perpetual preferreds, of course, it's a yield in perpetuity, but they never ever need to be paid back. This yield never ever needs to be paid back. The prefers that were issued are at a fixed yield, like the Stride and the Strife and the Strike and the Stream. Those issued at a fixed yield, they require Bitcoin to go higher than the yearly yield. So, for example, some of these yields were issued. Take Strike; it was issued at 8%. In order for it to make sense, over time, you would want Bitcoin to earn more than 8%. Some of the other ones that were issued at 10%, you would want Bitcoin to go up more than 10%. Of course, if you're a firm believer in Bitcoin like I am, you think it's going to go up way more than 10 to 12%. Way more than that. And so they are less of a problem. They could be somewhat of a problem if Bitcoin waits until 2060 to be worth $1 million. Then they could become somewhat of a problem, or somewhat of a cost. But I believe that over time, those perpetual preferreds with a fixed yield are going to be very meaningless over time because Saylor has clearly shifted his focus on Stretch. Why did he shift the focus on Stretch? Because Stretch has a built-in mechanism where you are going to drop the yield as Bitcoin rises. As Bitcoin increases in value, the collateral, the BTC rating behind Stretch, will become more and more pristine, more and more premium, and he will have the option to either ATM way more Stretch or decrease the yield of Stretch. And over the long run, if BTC plays out, which remember, to buy any of these companies related to Bitcoin, you have to believe in Bitcoin. If you don't believe Bitcoin is going to be worth $500,000 someday and then $1 million someday, if you don't believe that, you should not touch any of these. You shouldn't touch MSTR stock. You shouldn't touch the preferred. You shouldn't touch the converts. You should touch nothing if you don't believe in the Bitcoin thesis. But if you believe in the Bitcoin thesis, then in that case, you also have to believe that the Stretch yield will drop. And eventually, if Saylor becomes one of the leading companies of the NASDAQ, if we become a top 20 company, even a top 10 company, eventually the Stretch yield could be very similar to the yield of Apple bonds. We could end up paying very much 3 or 4% a year on Stretch. Stretch is the only preferred equity that makes sense to be issued at all times. Because 10 years from now, we don't know what the yield is going to be on Stretch, but it could be 4%. And then in that case, if Bitcoin won, if Bitcoin is the global monetary standard, yeah, Stretch might very well yield 4% or 5% or whatever the quote-unquote the Bitcoin near risk-free yield is, whatever that's going to be in 2045. That's what Stretch will pay. And Stretch will be the bulk of issuance of all of the preferreds, And I believe that at some point, so for example, Strike will retire when it converts, so Strike might be gone at one point. But I believe even the Stride and the Strife, I believe even those might stop being issued at some point. And we already reduced the ATM on one of the other preferred. So that's the idea behind the thesis. Perpetual is the keywords that I never hear the bear mention. And I think the bulls, I think we should talk much more about the fact that the prefers are perpetual. It's perpetual debt. It's debt that lasts centuries. And in centuries, the money will be worthless. Fiat will be worthless in centuries. So it's a very different type of liability than a short-term liability. Anyways, moving on. I also want to talk about Jack Mallers' take. And it's really a stereotypical take. He went viral saying, if selling equity for cash is not dilution, then I don't know what it is. No, selling equity for cash is not dilution because you get the cash. You get the cash into the business. The reason why people say it's dilutive is because it is their opinion that you're going to use the cash the wrong way or that you're going to do something bad with the cash. But if you ever look at the math, and this is a fight I've been having on this channel on so many companies who do equity issuance. If you ever look at the math, selling equity is actually neutral because you issue equity and you get the cash. And then the question is, what are you going to do with the cash? A lot of businesses have issued equity the right way. You may remember Tesla issued equity back in November of 2020 when the stock was a price very close to what it is today, and it's been sitting on that cash ever since. When Nvidia did the same thing, right? When stocks reach nosebleed valuations, selling equity to raise cash at high multiples on the business, high PE ratios, for example, and invest in the business, that's a very good idea. And I would argue, if you look at a stock like GameStop, for example, GameStop is nowhere near at risk of bankruptcy. Selling equity into the mania is what saved GameStop. So selling equity is not necessarily dilution. Selling equity can be very, very, very bullish at times. And in the case of Saylor, so you're selling equity at above mNAV, so you're creating a little bit of a yield. A lot of people complain the yield is very bad right now. I agree the yield is very bad right now. We shouldn't do that much equity. But we still earn the Bitcoin yield because the equity issued is issued to buy back Bitcoin. And if it's issued to buy back Bitcoin, you create a Bitcoin level network yield. You're creating a Bitcoin level network yield. If you remove 1 million coins from the Bitcoin network, which is what Saylor is going to probably be where he's probably going to be there in early 27. If you removed 1 million coins from the Bitcoin supply, you've created a nearly 5% yield for the entire network. So even from that standpoint, you could make the case, I know that's a bold claim, but you could make the case that issuing equity at a 0.95 mNAV is actually also neutral because you're creating a yield at the level of the Bitcoin network. But it's a stereotype. The fact that when you say, oh, selling equity is dilution, it's just a Wall Street stereotype that Mallers just repeated. It's definitely not always true. I've fought this on this channel for a long, long time. Even stock-based compensation. People always complain about stock-based compensation. Oh, you dilute for shareholders. You dilute for shareholders for stock-based compensation. That's perhaps a little more true because you can argue the executive is bad. And you can argue that the execs and the employees who get stock-based comp, you can argue that they're bad at their job. But that's a different argument. Technically, if you issue stock-based comp, you don't have to pay as much cash. You don't have to pay as much cash. You just issue stock-based comp, which you print your own currency to pay your executive, which keeps cash within the business, and you don't issue that much cash. Now, a lot of people get very, very mad at whenever businesses issue new shares, but even if you look at something like a stock-based comp, it's a cash-saving measure from the business. You may remember GE when GE was going through financial troubles a few years back. The CEO was only compensated in GE shares, in General Electric shares. That was it. That was it. And so if he had failed, the business would have very much benefited from stock-based comp. So let's be very careful. A business can print its own stock and it can be currency for the business, but it's definitely not always dilutive. It's dilutive when you take the cash and you invest it in silly investments to revive a dying business. That's when it's dilutive. But it's not always the case. And in the case of strategy, the investment is either cash, which if it stays in cash, it's definitely neutral if it stays in cash, or Bitcoin. And if it stays in Bitcoin, you're investing in a business that's growing at 30% a year ARR for the next, 10, 20 years, maybe a little less, because frankly, the bull rally of Bitcoin this season has been very disappointing. Nobody thought we would stop after 126. It's been a catastrophe. Bitcoin has been hit by a wave of macro headwinds, like few of us had anticipated. Who would have thought that the rates would still be this high in 2026? Who would have thought that we have Middle East tension in March, big Middle East issues in March of 2026? Who would have thought that? I wouldn't have thought that. So anyways, we still outperformed Bitcoin. Doesn't look as bad when you look at it this way, because Bitcoin, of course, was flat and strategy was only down 1.6%, but we still outperformed. We should be slightly in the green too. If Bitcoin is flat on the week, we should be roughly flat on the week. We're not. So maybe he ATM'd a little bit. Maybe that's the reason why. Want to talk about Stretch a little bit. Stretch is firmly sticking to 95.21 in after hours. Stretch, of course, the ex-dividend date didn't work out. We didn't see the volume come in. And so when is it back at 100? Well, there's some very meaningful stuff that happened the past 2 weeks in the market. Bitcoin crashed. Bitcoin crashed 22% in no time, in next to no time. Bitcoin crashed. So the collateral backing Stretch also crashed, right? The BTC rating dropped. So Stretch is not as good as it was when Bitcoin was at 80. So one of the things we need for Stretch to come back is we need Bitcoin to come back at least at 70. Maybe 68, 69, at least at 70. We need Bitcoin to come back. And then we've had the issues of odds of rate hikes, not cuts. Odds of rate hikes coming back. Now the CME Fed Watch tool telling us rate hikes are coming back in December of 2026. Most companies that, I follow banks. SoFi was expecting something like 3 rate cuts in 2026. No, we're going to get a rate hike, it seems like. The 10-year yield needs to drop. It's not dropping just yet. It needs to drop. And the yield and the rates is all influenced by inflation. And what is it that influences inflation the most? It's Iran, because it's the price of oil. Price of oil permeates the entire economy. Energy is a big chunk of the CPI. This Iran situation needs to stop. And by the way, this right now should be about. I took that screenshot like an hour ago. So right now should be about the moment when a deal gets signed. Like per this tweet, which was yesterday, about 24 hours ago. So right now they should be signing that deal. Of course, I'm being facetious. If you watch the news, something happened in the last 2 hours, and it seems like the deal is not getting signed. So that's why I'm being a little facetious here. Because here's what I don't understand: when Poach said a deal was going to get signed, and of course he's been saying that more than 30 times, might be even 40 times at this point. Like, I would think the markets wouldn't go mad green, but they still do. So talk, which in the real world you wouldn't trust this talk, right? You just wouldn't. In the real world, if somebody tells you something's gonna happen for 30 times and it doesn't happen, you wouldn't trust that person in the real world, right? If someone cries wolf 20 times about something and it never happens, you don't trust that person anymore. But the market somehow reacts to these headlines, which clearly, clearly we keep postponing. Clearly, these headlines are a joke now. The value of the word doesn't really matter because it's never happening whenever you make that word. Whenever you make a statement, the deal doesn't happen. So the value of the word should have dropped to zero. The value of talk should have dropped to zero. But not in these markets. These markets are so crazy that they keep believing in talk. So talk is not cheap, which is fascinating. If you follow things like signaling theory, costly signals, non-costly signals, Nobel Prize from the 70s. Is it Spencer? I can't remember the name of his Nobel Prize. We need to entirely review the theory of costly signals and signaling theory because non-costly signals are moving the markets like crazy. So we need to review that. That's very interesting to me. That's more theoretical. Anyway, so this needs to be signed. If it's not signed, we need to increase the yield. That's it. Simple as that. We need to increase the yield if it's not signed. I know it's not a good look. It's not a good look. It makes the bears' Ponzi argument get better. Because the bears will be like, look, see, he has to increase the yield into perpetuity. But that's because of the macro that we've had. The only reason for that is because of the macro that we've had. It's the timing that has been awful. And frankly, this is my take on this channel. I've made my take that take many times. In 2029, 2030, when we look back at the 2020s, we will say the 2020s were a lost decade. You better have not been in the markets in the 2020s. I think that's what we will say. And it was a stock. Maybe the indices are doing better, but we'll see. We'll see about that. We will see about that. It's been a tough time to invest in. Many gray swans after black swans after gray swans after black swans. Crises back to back. Anyways, fear and greed coming back yesterday, so right shortly after the tweet that would say a deal would be signed right about right now. As I record this, a deal should be being signed. Yesterday, right about when that tweet came out from POTUS, we moved from extreme fear 13 to 18. So we are slowly getting back into the fear territory, leaving extreme fear territory. On CMC Crypto Fear and Greed Index, which is the one I use, we are back into fear territory. This is bullish. We're just in fear territory. We're not in extreme fear anymore. And then lastly, what I wanted to talk about, of course, is the validation of Bitcoin by Elon Musk. And again, this is yet again one of these reasons where talk is cheap. Musk really doesn't really talk about Bitcoin, or if anything, or talks very negatively about money, says money is going to disappear, says Dogecoin is ironic, and so if it's ironic, it should win. Again, talk is not what matters. What matters is actions. Actions matter, at least in the real world. In the world I live in, actions matter. Tweets shouldn't matter. Unfortunately, in this crazy market, tweets matter, but that's the point of Saylor here. 25%, 2 out of 6. 2 companies out of 6 in the S&P 500 now hold Bitcoin on their balance sheet, and dare I say, they own a lot of Bitcoin on their balance sheet. Tesla owns 11,500 Bitcoin, and then SpaceX, which was just added, owns 18,700 Bitcoin. And if you look at this chart, you have a lot of operating companies who actually own a lot of Bitcoin, right? Bullish is an operating company. Mara is an operating company. SpaceX is an operating company. Coinbase is an operating company. Tesla is an operating company. Riot Platforms and CleanSpark, they're operating companies, but they're also getting into AI. So they're moving slowly away from their Bitcoin nativity. So the BTC treasury companies are now in the minority camp. And then whatever 21 Capital is. But the BTC treasury companies and 21 Capital are in the minority camp of companies that own Bitcoin. You have actual operating companies who own Bitcoin here. So this is a pretty big deal. I agree with Michael Saylor. It's a pretty big deal. The top companies in the US, the Mag 8, 25% of the Mag 8 now holds more than 10,000 Bitcoins on their balance sheet. That's a big deal. That's worth celebrating. The SpaceX IPO may turn out to be very good for Bitcoin. And let's see if actually with the crazy proceeds that SpaceX got on Friday, let's see if some of these proceeds are put into Bitcoin. Think about, because Bitcoin is oversold, right? Bitcoin is super low right now. And SpaceX is presumably very expensive. Think about what if SpaceX puts some of these proceeds in Bitcoin and then Bitcoin gets back to 120 towards the end of the year. That would look even more genius. So anyways, I hope SpaceX buys some more Bitcoin with their newfound cash. I really hope so. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you're entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.